Did you know that in the 1980s, a single bond trader at Salomon Brothers could make more money in a year than most people could dream of in a lifetime? Or that Salomon Brothers once controlled over 40% of the US government securities market? Liar's Poker by Michael Lewis takes us deep into the wild, high-stakes world of Wall Street, where fortunes were made and lost in the blink of an eye. In this video, we're diving into the 12 most powerful investment lessons from Liar's Poker. You'll learn how the legends of Salomon Brothers thrived in a market filled with chaos and competition. We'll uncover their strategies, from mastering risk and reward to leveraging insider information. You'll see how they turned market crashes into opportunities and how their innovative products changed the financial world forever. Get ready for a journey through Wall Street's wildest era. By the end, you'll have a toolbox of strategies that can help you navigate today's markets with confidence. Let's get started and uncover the secrets that made Salomon Brothers a powerhouse on Wall Street. 1. The rise of Salomon Brothers, a story of Wall Street's Wild West. Salomon Brothers, the legendary investment bank, wasn't just a financial institution. It was a powerhouse of innovation and audacity. Michael Lewis, in Liar's Poker, paints a vivid picture of how Salomon rose to the top of Wall Street in the 1980s. Their aggressive trading strategies and willingness to take risks were key factors in their success. At its peak, Salomon Brothers dominated the bond market, controlling over 40% of the US government securities market. This dominance wasn't just due to luck but a result of sharp minds and bold moves. One of the most remarkable aspects of Salomon's rise was their approach to mortgage-backed securities. They were pioneers, turning a niche product into a massive profit center. By the mid-1980s, mortgage-backed securities became one of the most traded financial products. The firm's traders, often described as big swinging dicks in the book, weren't afraid to bet big. This audacity paid off, with Salomon's revenues skyrocketing. However, the firm's rise wasn't just about risk-taking. It was also about strategic positioning and innovation. They invested heavily in technology, ensuring they had the best trading systems. This tech advantage allowed them to execute trades faster and more efficiently than their competitors. Additionally, Salomon Brothers understood the power of talent. They recruited the best and brightest, offering them unparalleled training and growth opportunities. 2. Inside the mind of Michael Lewis, unpacking the genius. Michael Lewis, the author of Liar's Poker, provides a unique insider's perspective on Wall Street. Before becoming a renowned writer, Lewis worked as a bond salesman at Salomon Brothers. His experiences there offer invaluable insights into the mindsets of top traders and investors. One of the key takeaways from his book is the importance of understanding market psychology. Lewis highlights how traders often succeeded not just because of their analytical skills but because of their ability to read the market's mood. Lewis also emphasizes the value of storytelling in finance. He suggests that the most successful traders were those who could weave compelling narratives about market movements. This ability to tell a story gave them an edge, allowing them to influence clients and peers. For instance, Lewis recounts how John Meriwether, a legendary trader at Salomon, used his storytelling prowess to dominate the bond market. Moreover, Lewis' reflections underscore the importance of learning from mistakes. He candidly shares his own missteps, offering readers a chance to learn from his experiences. This humility and willingness to learn are crucial traits for any successful investor. As Lewis puts it, the most important lesson in investing is that there are no certainties, only probabilities. 3. Risk and reward. Lessons from the trading floors. The trading floors of Salomon Brothers were a high-stakes battleground where fortunes were made and lost in minutes. One of the most crucial lessons from Liar's Poker is the relationship between risk and reward. Salomon's traders weren't just gamblers, they were calculated risk-takers. They understood that taking risks was essential for high rewards, but these risks had to be well calculated. A key strategy was diversification. Traders spread their bets across various assets to manage risk effectively. This approach is a cornerstone of modern portfolio theory, which emphasizes the importance of diversification in reducing risk. For instance, by diversifying their bond portfolios, Salomon's traders could mitigate the impact of market volatility. Another vital lesson from the trading floors was the importance of having a clear exit strategy. Salomon's traders knew when to cut their losses and move on. This discipline is crucial in investing, where holding on to losing positions can lead to significant financial damage. As one trader famously said, the first rule of trading is to protect your capital. The second rule is to remember the first rule. 4. The art of the deal. Negotiation tactics from Wall Street's best. Negotiation is an art, and the traders at Salomon Brothers were masters of it. Liar's Poker offers several insights into their negotiation tactics. One of the most effective strategies was leveraging information asymmetry. By having more information than their counterparts, Salomon's traders could negotiate better deals. This strategy is still relevant today. Investors who are well-informed can make better decisions and negotiate from a position of strength. Another key tactic was building relationships. Successful traders at Salomon knew that long-term relationships were more valuable than short-term gains. They invested time in building trust with clients and partners, ensuring repeat business. This approach is supported by data showing that customer retention is significantly more cost-effective than acquisition. Salomon's traders also understood the power of patience in negotiations. They knew when to push hard and when to hold back. This patience often led to better deals and higher profits. As Michael Lewis notes, in the trading room, the people who got rich were the ones who waited for the right moment and struck when the iron was hot. 5. Greed and fear. Psychological warfare in investing. In the high-stakes world of investing, emotions often run high. Liar's Poker delves deep into how greed and fear drive market behavior. At Salomon Brothers, traders knew that understanding these emotions was key to success. Greed pushes investors to take risks for big rewards. However, unchecked greed can lead to disastrous decisions. This was evident during the 1980s bond market boom when many traders made reckless bets that later backfired. Fear, on the other hand, can paralyze investors. It causes them to sell in panic during market downturns. Salomon's traders learned to control their fear, using market dips as buying opportunities. One famous quote from the book captures this well: "The market is driven by two emotions, greed and fear." Successful traders at Salomon harnessed these emotions to their advantage, turning market volatility into profit. To manage these emotions, traders relied on data and analysis. They used historical data to predict market trends, reducing the influence of emotions on their decisions. For example, during the 1987 stock market crash, traders who stayed calm and analyzed the situation made significant gains. This strategy of data-driven decision-making is still relevant today. Investors who rely on data rather than emotions are more likely to succeed. 6. The power of information. Insider secrets and market moves. Information is power in the world of investing. Liar's Poker highlights how Salomon Brothers used insider knowledge to stay ahead of the competition. Traders at Salomon had access to market-moving information before it became public. This advantage allowed them to make profitable trades that others couldn't. One of the key lessons here is the importance of staying informed. Modern investors can use various sources to gather information, from financial news to market analysis. In the book, traders often gathered in small groups to share insights and discuss strategies. This collaborative approach helped them stay on top of market trends and make informed decisions. Salomon's traders also understood the value of proprietary research. They invested heavily in research and development, creating unique models to predict market movements. This investment paid off, giving them a significant edge over their competitors. Today, investors can benefit from using advanced analytics and research tools to enhance their decision-making process. 7. Bond trading mastery. Insights from Salomon's top traders. Bond trading was Salomon Brothers' forte, and Liar's Poker provides a detailed look at their strategies. One of the key insights is the importance of understanding bond pricing. Salomon's traders were experts in valuing bonds, considering factors like interest rates and credit risk. This expertise allowed them to spot undervalued bonds and make profitable trades. Another crucial strategy was the use of leverage. By borrowing money to buy more bonds, traders could amplify their returns. However, this approach also increased their risk. Salomon's traders knew how to balance leverage and risk, ensuring they didn't overextend themselves. For example, during periods of low interest rates, they increased their leverage to maximize profits. Salomon Brothers also excelled at market timing. They knew when to enter and exit the bond market, capitalizing on favorable conditions. This skill was particularly evident during the 1980s when they made significant gains from the high-yield bond market. Modern investors can learn from this by paying close attention to market signals and timing their trades effectively. 8. Ethics on the line. Navigating moral dilemmas in investing. Ethical dilemmas are a recurring theme in Liar's Poker. Salomon Brothers often walked a fine line between aggressive trading and unethical behavior. One of the key lessons from the book is the importance of maintaining integrity. In the long run, ethical behavior builds trust and reputation, which are invaluable in the world of finance. For instance, the book highlights several instances where traders faced ethical choices. Those who chose integrity over short-term gains often found long-term success. This is supported by data showing that companies with strong ethical practices tend to perform better financially. Trust is a crucial asset in investing, and maintaining it requires a commitment to ethical behavior. Salomon's experience also underscores the importance of regulatory compliance. The firm faced several legal challenges due to unethical practices. These challenges not only affected their reputation but also led to significant financial losses. Modern investors should prioritize compliance with regulations to avoid similar pitfalls. 9. Surviving market crashes. Lessons from historical turmoil. Market crashes are inevitable, and Liar's Poker provides a front-row seat to some of the most tumultuous times on Wall Street. Salomon Brothers navigated these storms by staying calm and sticking to their strategies. One of the key lessons is the importance of preparation. Salomon's traders knew that crashes were part of the market cycle. They developed contingency plans and kept cash reserves to take advantage of buying opportunities during downturns. For example, during the 1987 stock market crash, Salomon Brothers managed to come out relatively unscathed. They had diversified their investments and maintained a strong liquidity position. This approach allowed them to buy undervalued assets while others were selling in panic. As one trader put it, crashes are opportunities in disguise. Another vital strategy is understanding market fundamentals. During crashes, emotions often drive decisions. Salomon's traders relied on fundamental analysis to identify good investments amidst the chaos. They looked at company earnings, balance sheets, and market position to make informed decisions. This focus on fundamentals helped them avoid the herd mentality and make rational choices. 10. The role of innovation. How new financial products change the game. Innovation is a game changer in finance, and Salomon Brothers was at the forefront of creating new financial products. Liar's Poker highlights how Salomon's innovations, like mortgage-backed securities, revolutionized the market. By packaging mortgages into tradable securities, they unlocked a new revenue stream and created a liquid market for home loans. The creation of mortgage-backed securities is a prime example of how innovation can drive growth. By 1985, the market for these securities had grown to over $1 trillion. This success was not just about the product but also about educating the market. Salomon's traders spent significant time educating investors about the benefits and risks of mortgage-backed securities. This effort paid off, as more investors began to see these products as valuable additions to their portfolios. Innovation also involves continuous improvement. Salomon Brothers constantly refined their financial models and trading strategies. They invested in technology and research to stay ahead of the competition. Today, investors can learn from this by embracing new tools and technologies, such as artificial intelligence and machine learning, to enhance their investment strategies. 11. Networking and influence. Building powerful connections. Networking is a powerful tool in finance, and Liar's Poker shows how Salomon Brothers leverage relationships to their advantage. The firm's traders understood that building a strong network could open doors and create opportunities. They cultivated relationships with clients, competitors, and regulators, ensuring they had valuable connections across the industry. One of the most effective networking strategies was providing value. Salomon's traders didn't just network for the sake of it. They offered insights, advice, and assistance to their contacts. This approach helped them build trust and establish themselves as valuable partners. For example, they often hosted seminars and workshops to educate clients about market trends and new products. This not only built goodwill but also positioned Salomon as a thought leader in the industry. Networking also involves maintaining relationships. Salomon's traders stayed in regular contact with their network, ensuring they were top of mind when opportunities arose. They understood that relationships needed nurturing, and they invested time in keeping connections strong. Today, this lesson is crucial for investors who want to build a robust network that can provide support and opportunities over the long term.